Hi, this is Randy Finney with Right Side of the Chart, and this is a early session update for Monday, January 27th, 2025. In this video, I'll start out with an overview of the equity markets, look at what's going on there, reiterate the key levels, support and resistance levels, levels to watch, developments to watch for. We'll talk on treasuries really quick. That trade couldn't be working out any better. Today is a great example of why I like indirect versus direct hedges. Both the index shorts were down big this morning, meaning profitable. Treasuries were way up, especially over last night. Bounced, as expected. I got a post out there this morning looking for a little bounce, but that may have run its course. I'm going to go over the charts and get to that in a second. I'm going to take the video home with just highlighting some of the some commodities, including a couple new trade ideas. One's actually cocoa. I threw out a couple a month or two back. Coffee's looking good too for a short trade. Let me just start out here. I want to thank member Blueberry for posting this article or link to this CNBC piece. This is what knocked the futures down. If you're not aware, again, I mentioned this morning, the NASDAQ 100 futures were down over 5% last night into the at the lows before the market, before the turnaround this morning. And this is it right here. I watched the first part of this video. It's exactly, I addressed this in at least one video going back about a month, maybe 2 months ago, stating, talking specifically on NVDA and the U.S.'s ban on, strict ban on NVIDIA chips to China. And I said exactly this would happen, that China, of all countries out there, is the most resourceful. By doing that and banning them from these chips, they found a way around it, and they found a much more efficient way. So I've talked about that it was only a matter of time before China would come in and figure this out and have their new AI models. They'll make their own chips. And so, and that ties into the market. NVIDIA has been one of my favorite shorts recently. We have, the bearish engulfing candles that were put in. I have long-term targets I've maintained for a while now. We did hit the first targets. I'll get to NVIDIA in a second, but this plays into all that. So to take a look at the video, if you, want to see what's going on there, it's pretty impressive. But again, it's exactly what was inevitable, and it's going to continue. There's just tremendous amount of money when there's many billions of dollars of profits sloshing around a particular product or industry. You can bet your ass that and then especially the U.S. says no, you can't get in on this. Again, so this was, the writing was on the wall for this. And now where I'm going is, so, okay, let's just say whether you care to short NVIDIA or not, NVIDIA is, as I've maintained for a year now, the stock market. It is, I've said for a while, the single most important stock. It's the poster child of AI. It has that mathematical weighting, but more so the psychological importance. And so let's see if this is a start of something else. So let me get to the charts, and we'll go there. All right, this is NQ, NASDAQ 100 futures. This just couldn't be playing out any better. We went long here off the divergent low, highlighted that as the 60-minute divergences, which I like to see. Got a rally, hit my minimum target here, expected a pullback, which we got, and broke out above the downtrend line, breakout back test. And then at that point, I said, if we do break out of the trend line, which we did, then I gave you two targets, that reaction high and that reaction high. That's the one we hit the other day, giving you a short opportunity again there. And then we had my beloved negative divergence at that high. And that's it. We went down. We parked Friday where I said we would probably park while the session was still going on, right on that level. And then this is what happened when the futures opened Sunday evening. I guess that piece came out over the weekend, and that is what they attributed to the big drop. NVIDIA got clocked on that, and again, rightfully so. You're not going to sit at the throne indefinitely, again, without other countries, particularly China, coming out, and trying to get a piece of that themselves. All right, so where do we go from here? Let's, right now, based on that, at most up to this level, we may not get there. This is a pretty, things like this. When you look at QQQ, let's do that. Let's look at QQQ real quick. Carvana still looks nice, back testing from below. QQQ right here. When you see these kind of gaps, I love these kind of gaps when you see this. First of all, you have it's not at the highs, but it is an island cluster right there, an island cluster reversal top. It's just off the highs. Remember, on the weekly chart, well, I'm looking at a daily right here. We had, this was on the weekly, a bearish engulfing candle, which, I laid that out as a swing short, trend short entry for the long-term targets, and that's still very much intact. So we're still profitable. If you did that, of course, as an active trader, I talked about gaming this bounce that we had and then getting back short again. And so either way, that's profitable. That bounce was profitable, this reentry. But what I wanted to show you here is this again. Here's that cluster of candles right there, very close to the highs. Either way, what I love to see when I am bullish and long, I love to see a big gap up, not a little gap. We get little gaps all the time on QQQ, especially on the weekends you're going to open up. But the bigger the gap, what it does, it traps longs. It traps longs, and it denies a lot of shorts, so you don't get heavy short interest on a breakdown there, because if you weren't already short going into last night, the last thing you should have done is shorted, early this morning. If you were up last night, went 5% down. How much more is the NASDAQ going to go down in a day? That's an extreme move. I've seen it usually only happens in bear markets. And again, maybe this is early stage bear market action. Don't see 5% down moves in the futures so often in bull trends. So keep that in mind. Either way, what it did here, if you went home, let's say long QQQ, you were bull, or you were waiting to short, you didn't have any short positions at all, that big gap denied an objective entry. And by the way, you gap down to support. Here's a level I had right here. So again, that's, we're going to bounce, and futures were down, more than that overnight. Where do we go from here? Again, let's just do what I covered on Friday. We have the long-term charts gave us sell signals. There's that bearish engulfing. There's the breakdown of the uptrend line off the August 5th lows. And that's it. So today's price action, let's go over the big market leading stocks real quick. Starting with NVDA down 14% right now, right to the 200-day moving averages, which, I said once we broke this trading range right here, that would be the next stop. Just like Apple, the lemmings tend to buy, the bots and the humans both together tend to buy pullbacks to the 200s. However, this is a lot of technical damage done. This big gap down traps a lot of people. Think about institutions, hedge funds, pension funds that are overloaded in this stock. This is an overloved, overowned trade. And this is what happens when you have a quick, sudden rush for the exit. So I would just say I wouldn't, at this point, and I kind of mentioned that on Friday too, trying to go long at that support level. I said, no, it's like picking up nickels in front of a steamroller. Not, even though I expected the market to stop there, not a level to try to game a bounce on. And this thing just looks like it's rolling over. And let's not forget, NVIDIA, most importantly, NVIDIA here, and I'll leave it here, that purple trend line is the primary trend line I've been harping on for a long time. Is such a very well-defined, very technically significant trend line. Lots and lots of reactions, and that broke down. So, when we zoom in, we had a breakdown, a recent back test with the bearish engulfing candle that marked the high so far. I said that's a very objective short there with a stop below, plus a nice rejection. As I always say, it's one thing when you're short a back test of a trend line. The problem is you can continue to back test and you can go up. So I like to see, which we got, as highlighted, that impulsive rejection off the back test. Now we've taken out the bottom of this trading range. So I'm going to just keep this very simple. Support once broken becomes resistance. Here's your trading range, or I'll box tool it. So any rallies back up to it, I would give it a little room. Offers an objective short entry. You could get it. I don't know. I wouldn't hold out for it. And once we're clearly below the 200-day moving averages, especially on a weekly closing basis, then that should open the door to my longer-term targets, which again were laid out last year, and I still very much maintain. all the way down here. T4 is still my current final target, down to $40. Remember, we hit my first target there. We covered NVDA and all shorts on that day. That was August 5th lows. We hit the 200-day moving averages, which again on the weekly chart are your 40 period. When you go to weekly chart, you have to change it to a 40 period because there are 5 calendar days in a week. 5 times 40 equals 200. Same thing as your 200-day moving averages. And NVIDIA remains in a bull trend unless those are taken out. Once it's taken out, you are in short mode. You short rallies back to the 200s, and then you short them, and then you buy or flip. Again, with other things too. We look at the market, what it's doing, the rest of the mag 7, 8, 10, whatever you want to call them. But there's a bear trend, and it may not look like much. Once the 200s were taken out right there, NVIDIA still had another 58% to fall. And so if my fourth and current final target is hit, that's going to be a drop of, whatever. I measured it out back here. I first laid those targets out here. But remember, we hit T1. And as we often do, upon the initial tag of each target, a bounce is likely, especially if the charts indicate it, which they did back then. That was the first pullback to the 200. And this is it. And like I like to say, yeah, if you're bullish, you can buy the 200s. But thing about it, this chart indicates sooner than later, the 200s are going to get taken out and the trend will change. Nothing goes up forever. And again, now you have a pretty decent fundamental catalyst that goes with the technicals. But I always say this, the technicals come first, and that was it. They're beautiful breakdown, back test. You can see it nice and clean on the weekly chart. There's the primary uptrend line. All right, that's it. So there's NVIDIA. Again, we're at the 200. You can cover short if you shorted there, but if you're keeping your eye on the prize, these longer term deeper targets I showed you, then there's a whole lot more meat on the bone left there. All right, but it's a lot about NVIDIA. I don't want to, don't take me literally when I say it's the stock market, but it is, in my opinion, again, the single most important stock. Apple's a close second. Apple, I highlighted again, hitting the 200 the other day. Said they will most likely step in and buy it, which they did. Now look where Apple went. We hit the 200. It was an objective long entry. They bought the 200 right there. This is a daily chart. And they bounced back to close. This is resistance. There's a gap right there. We've just backfilled that gap. So that sets the stage for the next leg down in Apple. And Apple, the trend indicators are now bearish on the PPO. You're below the zero line. That's what you see down here. Let me make it big and clear for you. This is the zero line. It delineates bullish and bearish trends. What you want to look at is the white line on this chart, the 9 EMA. I like to use that because it's the last of the two to cross, so it helps filter out whipsaws. When you're above it, the trend is bullish. You want to be long and strong. When you're below it, the primary trend is bearish. You want to be short. Above, bullish. Below, bearish, right? Simple. This is log scaling. These drops are bigger than they look. I've squished up just to show you this. So you can see there. So there it is. So bull trend. You see how the white line back test, how it acts as support when tested from below. Once it clearly goes, the trend has changed. And so, we had sell signals here. I highlighted Apple as a short back here. Again, when the secondary, larger, more significant trend line was broken. And right now I'm highlighting it. If you game to bounce off the 200-day, it's an objective short entry or profit taking point. Or, you can keep Apple on as a hedge if you think it's going to outperform. Or if you're bullish, this is one of the favorite. If you're bullish, you should be long Apple and NVIDIA right now and pullbacks to the 200 if you think this market's going to new highs. Maybe I will be long those two stocks later, not today, not anytime soon, until I see, take a little bit more than just a couple days bounce to convince me. Again, it's based on the technicals. So let me continue on a few more. So we know where Apple stands. Microsoft, this was the latest trend line here. Breakdown, backtest. It's been whippy. Again, a lot of these big market leading stocks have gone nowhere now. For this one's been almost a year. If you turn off all my lines here, take Microsoft right now, I'd go back to this point right here was in February. So almost a year, this stock has gone absolutely nowhere. This is indicative of a market top. Could be high level consolidation if the market's going to new highs too. It's simple. If it breaks, if we break out there, especially if we burn through the divergences, then that's a different story. And I'll be talking about that if and when that happens. I just don't see that right now. Amazon right on this trend line right here. So there's still a little work to be done. We had a big check mark with NVDA obviously today. I go in check marks here for the bearish case. This is what I want to see Amazon take out, the trend line, and then this price support there around 216, 217. Alphabet, and remember the what's clocking. If you watch that video that Blueberry posted, they talk about the insane amount of money, 50 billion or whatever, with Alphabet and Microsoft, all these big tech companies spending on AI, and this little Chinese startup did it for like 13 million or something. Wrote code that's just much more efficient. It can use lesser chips since they can't use the highest, latest NVIDIA chips. And they're doing what the Chinese do. It's what they've always done. We invent here in the U.S. Most technologies and things like that. Even products, TVs, when you name it, cars, they come in, they just do it cheaper and better. They just mimic, reverse engineer, or get ahead, and so that's what they've done now. So it'll be interesting, guys. Everyone's going to be watching. Look, the week, as I said before, the week is not over. There are a lot of big reports, including Apple, coming out this week. You got a Fed meeting. Fed's expected to do nothing. So I'm not going to say it will be a non-event. It's more about what the Fed says and what they do. Last I checked, it was a virtual near 100% probability that they're not going to change rates. They're not going to raise or cut. So that's this Fed doesn't surprise. So you can almost take that to the bank. Now it's about what they say, but more so this week is what these big tech companies say. And then even more so than what they say is how the market, how the street reads between the lines, because it's all about this AI spending. I've been talking about this for a long time. They've got to see the return on investment. And from what I've been reading, 2025 is a year. This is a year investors are going to want to see that people are signing up for that Google Gemini, which they gave to me free, and I turned it off. I don't even, if I have zero, that's just me. I know others find value in these things, Microsoft Copilot. But until people start whipping out their credit card and ponying up for the subscription, this is a tremendous amount of money sunk into something again. And now if the Chinese are doing it at a much cheaper, cost-efficient way, that's huge competition. So anywho, just keep that in mind that this week the market is going to hear what these companies have to say. We know they always beat earnings. It's very rare that they miss. So obviously a miss wouldn't be good, but it's more about the guidance and then what they say. So don't overreact to the initial earnings release and after hours on any of these companies this week. It's more so how the market trades those stocks once they hit in the regular session, really how we close this week out. Now, as I often say, heading into earnings, I like to play a little game that I predict where stock's going to go. And I say it's simple. If the charts to me are indeterminable, meaning I can't make a strong bullish case or a strong bearish case, then it is a crapshoot. You might as well go to Vegas and put your money, on the roulette wheel, and at least you get free drinks. Is what I like to say. Don't waste your money gambling a stock into earnings. But if the charts are clearly bullish or clearly bearish, more often than not, that's the direction the next trend is going to be. Not the day after earnings or the evening of. I'm talking the next 10% plus move. And on that, I often say this. More often than not, is far from always. So just because, my charts tell me that coming out of this earnings week, that a lot of these big tech stocks are going out. I wholeheartedly believe that. I'll be positioned, and this moment I bounced long, but I reversed back short right before the video. I told you this is probably where we're gonna may stop the rally. I'll get to that in a second. I should have covered that with you. I'll get back to it. This is where I say Alphabet would be going. Another run back at the 200-day moving averages. It's been bouncing. Buy the 200s. You have a beautiful uptrend line you can see right below. I know this is a busy chart, but if you just pull that trend line right here that comes off the January 2023 lows, this yellow trend line, let's make it nice and fat. You can see that it comes in right below these red and blue lines, the 200 simple and exponential, and that is a downside target. And it's a target not only do I suspect will be hit this year and probably this quarter, maybe even this week or the following week, but it's a level that I think will ultimately go. And when it goes, when I have the majority of these MAG 7, 8, 9, 10, whatever you want to call them, stocks below their 200 days, then you embrace the bearish trend, and then we'll be in, you can get more aggressively short rallies back to resistance, gain counter trend bounces, and we're not there yet, guys. Let me just say that. Let me not get ahead of my skis here. There's still plenty of these stocks above their 200-day moving averages. Apple just successfully hit and bounced off it. NVDA is on it right now. So it is not time, despite last night's clocking in the NASDAQ futures, it's not time to be aggressively short the indexes or the NASDAQ tech stocks, tech indexes, or especially if you're unhedged. And again, I'll get to the treasuries in a second. It's just working out really nice. Meta, there's the uptrend line right there, the primary uptrend line on Meta. This one I have coming off the October 2023 lows. We're still above it and comfortably above the 200-day moving averages right there. So you have price support 540. If let's say you're an options trader. I prefer futures and then shares, just straight shares. Certainly dabbled in options, had plenty of time trading options and plenty of experience. It's just not my thing. But if you were and you want to know, timing wise, if you think this one's going to come out on the backside of earnings, then where's the target right there? 540.23. It's a beautiful, beautiful level. It's great price support. It's the 200-day moving averages and all that. And that would be a drop of, if hit, about 18% right there. And then most likely, again, depending on what's going on with everything else out there, the other big stocks. I'm going to move that line up just a hair, call it 544.14. They'll likely step in and buy the initial tag down to that level. All right. Tesla's doing what Tesla does, getting rejected off that downtrend line. Still have these longer term targets, still very much like that one. Broadcom clocked today down to this that bottom of that gap right there. And if it enters the gap, it's a big gap to be backfilled. There's your next target, and that's where I suspect it's going. Remember, that was a big divergent high right there. And there's your primary uptrend line in purple. That one comes off the October lows. So these are the top components. I'll round it out with Netflix. I still very much like this one longer term. This is my recession play. I made a call this year that it'll be my little thing. I don't do social media, but if I did, it'd be hashtag cancel culture or whatever, something with the word cancel. I think that'll be the big buzzword later in the year. You'll be reading how all these streaming services, people, I don't know, I'll use the term streaming exhaustion or something like that. I can tell you, and I've said it, I've got Paramount Plus, Apple TV, Netflix, of course, YouTube TV is my go-to channel. YouTube itself is trying to now force everybody into buying YouTube Premium. If you watch YouTube videos, you know that because they're just pounding you with commercials to the point they're just, trying to force everybody into the $20 a month or whatever it is for YouTube Premium, or you just will be tortured with commercials. So my point is, when the consumer breaks, and they will break, I'm not doing it in this video fundamental thing, but I've covered the alarming surge in credit delinquencies, especially the smaller banks, the people behind on their credit, the amount of credit, the charge-offs from the banks. And so the consumer is tapped. You have the haves and the haves not. And we know in recent years, there's been a disappearing of the middle class. A lot have been shifted down to that low level where they're just they're keeping the economy going because they're spending. It's very simple. If you're wondering how this economy has been so damn resilient in the face of rising interest rates, it is exactly that. Just look at the credit. Go to the Fed, the Federal Reserve of St. Louis website. I've showed those charts, and look at the explosion in credit card debt. And especially now you're seeing, the delinquencies, car loans, all that. So it tells me definitively the consumer is financing their spending, their vacations, and all these TV subscriptions they just can't do without. And there's going to come a breaking point. And the breaking point's simple. If you're wondering how we're going to have such a bad recession going forward, it's all this. It's this. It's this. When this goes down, NVDA goes down to my long-term targets. It's going to bring QQQ and the rest of the big overweight tech stocks down, and then they're going to go down and ultimately hit. I'm still maintaining T7 down here, which I have since back here, and that's going to take from the highs about a 50% drop in the NASDAQ 100. NVIDIA is going to go down much more than 50, but that's where the market's going to go. And so if you're wondering, how, with so many economists looking for no recession, a pretty good year, the economy's on sound footing, I read all this stuff. How's it going to happen? It's simple. They don't factor in this. The technicals are what they are. So if we get this and we go down here and we start dropping, so let's just say we hit my next target. Remember, we hit my second target here and bounced. 200-day moving averages, expected the bounce there. This is just a marginal. We're back to where we started back then when I laid these targets out in my market top range. So let me just do the math on it. So from the highs, from people that were buying recently, when we hit T3, we're going to be down 23%. I know from reading that we have an insane amount, a record high amount of concentration in equities. The old 80-20 rule isn't there anymore. Where people used to diversify, or 70-30, depending on your asset allocation model. Bonds have had their worst performance. Was it in history or 90 years? I've read one of the two. I think in all-time, bonds are just garbage now. Nobody wants to own them. They're great trading vehicles. We've been trading bonds successfully. I've had a great last couple of years trading Treasury bonds long and short, but they're not a good buy and hold vehicle anymore, and nor could they be when you're coming off a near zero rate environment. I made that absolutely clear a couple of years ago, right after COVID. And it was, to me, insane. And I thought it was, next to criminal negligence when the regional banks blew up, having so much money in treasuries. It's a mathematical certainty, and how the people that ran those banks didn't know that when you buy treasuries at virtually zero interest rates, you have absolutely no upside appreciation. At best case scenario, you stay in a zero rate environment forever on a 10, 30-year bond, 10, 30 years, and you collect paltry interest, less than 1% interest. And then the probabilities were about 99%, I would say, close to 100, that interest rates would be going up. And then therefore, as we all know, if you're in the financial markets, interest rates go up, bond prices go down. So the blow up in the regional banks had to be bailed out. That was all so clearly, it was virtually guaranteed. And then that happened. Of course, government bailed them out and all that, and lets them, move all those mark to maturity bonds off the books. But doesn't matter. Let's just go back to the mathematics here. So if we get down and then we hit, let's say T4. T4 is going to be a drop of about 28, almost 30%. And again, as I've been reading, and I know this what took equities up to this stratospheric level, that we have record high amounts of capital concentrated in equities right now. And we do know, if you look at any 401k, break it down, everything, whether you're in an S&P 500 fund, whether you're in a more aggressive growth fund, there are other options. But again, most people have very little, if any, bonds. And all those index funds are now loaded with the same handful of stocks I'm talking about here. The Mag 8, Mag 10, it's due to cap weighting and everything else. So they go down, it all goes down. They get down here, and so you're looking at the wealth effect being knocked down relatively quickly. The one thing I said, and I said it on Friday, I believe, I say it all the time, keep in mind, stocks fall a lot faster than they rise. So we saw that 5% drop in the futures last night. So this 28% drop to my T4 level, which wouldn't surprise me if we passed T3, really wouldn't. That could happen in very short order. And so now where I'm going with that, try to imagine throughout the entire country or even the world, a lot of most other people outside and governments in other countries have a lot of money in U.S. stocks now because it's been the best market. So over one quarter, nearly a third of your wealth is wiped out. That has a domino effect. So for those economists that can't possibly even see or fathom how we're going to have a recession this year, it's all about this, and it's simple. If I am wrong and we don't go down here this year, or down here, or down here, and we go here, then yes, this economy can keep chugging along. It's the wealth effect. People are going to have money in their 401ks. They're going to have money in their homes. But if this goes down, housing prices will fall, equity prices fall, consumer spending falls. They start canceling. People are forced to cut back on some of their 8 subscriptions to streaming services, Spotify, Pandora, SiriusXM, and all the TV streaming things and all that good stuff. So that's that. All right, taking a little bit long here. I'm going to go to, told you where the markets were today. Let me go to QQQ, show you the shorter term. If you're just trying to trade short term, I always say, 15-minute chart's going to get you in out quicker. There's a big gap right there. Actually, that gap is right there. But you can see I had this line here on that 15-minute chart. This is, I think, today, if we do turn around and go back up, that would be another level where we reverse. But right before the video, I figured, I told you this morning, I think I drew arrows. Yeah, I did. I gave you charts this morning with some arrows showing where we might go. Okay, here it is. So for the active trade, this is the chart I got out to you this morning. Made sure I got this screenshot of this right before the open. Got out to you right after the open. See, it's this reaction high there, come across there, reactions there, this reaction low, and that level is right here. So in the chart I showed you this morning, I hand drew it in with the annotation tool, so I'm going to add it to the chart. And you can see by my arrow, that was it right there, and that's why I reversed right before the video because we just hit it. And again, that shows you solid arrows are always my preferred scenario. Dotted arrows, they're little, I de-highlight the color a little bit, tune it down, are the alternative scenario. And that's it. So I'll probably one time before, either during this video or right after, we've already gotten a nice pullback there off those levels here. Let me get back to it and then game back in. But that's active trader stuff. You can't, looking at a gazillion different charts right there. We come back down there. Boom, here, we're going to bounce right here. So that's where the arrows had it going this morning. Hit that, pull back, and then this is nice support there. And they'll probably step in and buy it right there. Here, if you can't see it, we're almost there now. It's right there. See? That's where I give you this morning bounce target. There's, we'll probably step in and buy, get a little bounce up, and then who knows from there. Keep things light, wait for the next objective entry. Swing trend, long-term swing trend traders, this is all micro stuff. And again, I'll go to the 5-15-minute charts and play around and just bounce the MQs back and forth today as many times as they let me. All right, that's 33 minutes too much. Let's move on. You have all the levels. And again, bigger picture today is nothing but bearish, longer term. It's, the big stocks are still reporting this week. So about the only close to guarantee I can give you this week is expect some volatility, which if you're an active nimble trader, great. But you also need to expect whipsaws. There, from my experience, tend to happen more often during the week. I mean, this is it. This is peak earnings week. To me, I call it peak earnings week because it's the biggest companies, the ones that matter the most, and also the Federal Reserve meeting. So you couldn't ask for a more important week on the calendar, both economic calendar and earnings calendar. TLT is at that 88.32 target. Remember, we had the bullish bond wedge breakout. Up nice, strong day on Treasuries. Again, so this was a great example how, it was a pure play long based on bullish technicals on bonds, first and foremost, as always. and also an indirect hedge to equity shorts, which has been for me kind of an on-off thing, but I've all along maintained, holding on to this. And then I reiterated, I still very much like Treasuries on Friday, last week on the pullback, just a natural pullback. There is some potential negative divergence, but as of now, I'm still eyeing this 89.65 as my final target on ZB. And again, the fact that the indirect hedge, my point was, both very profitable today, the index shorts and the Treasury bonds as well. So that's the best kind of hedge where you can, if you get it right, they both make money. But then on the bad days, for the reasons I stated, if Treasury bonds go down, the stock market rallies. I'm sorry, Treasury bonds go down, it means rates go up. And therefore, that's going to check any rally in the stock market. All right, let's see, where is ZB for you futures traders? Here, let me start with ZN. ZN is at that target now, the 109.086 target. Remember, we already hit it once there, and we also have potential negative divergence. So at this point in time, although I can see the potential for more upside, I am lukewarm. I'm not red hot on treasuries anymore. Now, you can see here there's a potential. This is a 2-hour, 120-minute candles, 6 months of history. What looks like a nice inverse head and shoulders pattern. If it breaks out, the measured target on an inverse head and shoulders pattern is the distance between the head and the neckline. You add that to where it breaks out, and that would give you a measured target. So breakout there will, most likely, especially if we can burn through that divergence, could take us up there. And what we may get soon, what we got last night for sure, is that thing I told you we get on a big drop in the market. Remember, NASDAQ was down over 5%. The S&P went down over 3%. Futures last night, and you got exactly what I said would happen, a flight to safety bid into treasury bonds. Institutions were selling stocks, selling beloved NVDA and all that stuff, and covering their ass by moving into treasury bonds for safety. And so that played out well. ZB, the 30-year, the long bond, trade more for the juice. There's a reaction high right here, which we just hit, so I should add a line to that level. I'll do it right now. That was the previous reaction high, and now we've had two reactions. So we had that one there, and we just had a reaction there. We do have, as with ZN, the 10-year, we also have the negative divergence I just showed you right here. And again, that was my initial and still is my maximum bounce target. There's this downtrend line I've had here since last week at least. We pulled back to it, and so if we can hold here, or a little bit downside, a little more downside to this uptrend line, we could get that one last thrust. And then if so, if I am still long treasuries at the time, which I am now, I will be closing out my position if we get to that final target. That's the target I've maintained all along right there. KC, somebody brought up, if you watch the headlines over the weekend, Trump's little spat with Colombia. If I recall correctly, Colombia agreed to take back a bunch of migrants. The U.S. sent up 2 planes full of migrants while in the air. Colombia's president came out and publicly said, no, it's, you shouldn't treat migrants like criminals. We're not going to take them. They wouldn't let the planes land. Trump threatened the tariffs, 25%. It would be increasing 5%, steep tariffs. Colombia is, I believe, we're by far their biggest trading partner, and so that would hurt Colombia a whole lot more than them. Long story short, the president immediately, their president, cowed down and they decided to accept them with Trump's threat of steep tariffs. And so somebody said, "Oh, Randy, well, that should be bullish for coffee. Can you show a chart?" I said, "No, on the contrary. I saw that headline yesterday. I shorted coffee from it. That's net bearish. If we were to instill any tariffs on Colombia for 2 reasons, but mainly, tariff. Let's just go with 25% tariffs. So you're looking at coffee. Let me show you. Coffee is at multi-year highs. Let me just grab a long-term chart for you real quick. Commodities here, go here, gas. I'll get to that in a minute. Go to coffee. Where are you, coffee? I've got you here somewhere. No, that's my daily. I want my weekly. I just updated the weekly. Here we got another one here, somewhere in here. Bear with me. All right, this work. Maybe I didn't update this on this platform yet, but I can, I'm sorry, I just look at the line. This is negative divergence right here. There's a higher high. In fact, we've been building divergence from this point. It's getting very steep right now. You can see the slope of the lines dropping off. This is your primary uptrend line where I think coffee will come back to. So big divergence. This is multi-year highs. This is going back to 2018 right here. So you're looking at coffee already at, by far, the highest price it's been in years, maybe an all-time high. I'd have to go back to my weekly and look. It's been a while since I've traded coffee, but I mean, this is my long-term. This is my weekly chart here, and you can see I think you can see if I can center the chart for you. And I love these divergent highs, and we do have one now. So I just drew it out there. In fact, big divergence. It's like this. I'm drawing the lines down here. This is the big divergence right here. There's a big divergent high with the smaller divergence on the daily chart I just showed you there. There's the uptrend line. So this is coffee. Okay, so now let's say you get tariffs. What happens? So coffee now, the price just went up 25% that you, I, or the vendor Starbucks has to pay for coffee, right? Buying, of course, from Colombia, where most of the coffee comes from. So you get demand destruction, all right? If a cup of coffee all of a sudden goes up more, coffee's already at nosebleed levels. That's net bearish for coffee prices. That's not a good thing because you don't participate. You don't get the 25% increase in the cost of coffee doesn't go in your pocket if you're trading futures. It goes to the government's pocket. It raises the price. So then that puts downward pressure. Anyway, so that's my fundamental reason. Now, the technical reason, I never short anything solely on fundamentals. This is a 60-minute chart, KC Coffee Future, showing you the big divergence has been building here on this 60-minute chart. Drop down. I already showed you a weekly chart a second ago, but go down to a 15-minute chart, and this is what you have here. That's a divergent high. There was that last thrust up yesterday. And now breakdown back test. That was my first target, but I'm planning on swinging it down to this level right here. This is T2, T3, just levels I think we get reactions along the way. That's not my tool. Something like this. Boom, 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 boom. And so that would be shorted somewhere in here. It's going to be about a 5% drop minimum. And then I'll look to the long-term charts, those weekly charts. Again, to just go back to that, the potential for a whole lot more based on this. When you look at the moves in coffee off the big divergent highs in the past, the potential is for a much, much larger drop in coffee. The other one I like is cocoa. I don't have this long-term chart fully marked up. I just have this massive divergence right here. Highlighted cocoa back here just a few months back before the end of the year as a long-term swing short. They had issues with crop, pests and other things over in Africa where most of it's grown, most cocoa comes from. And they've been shifting crops over there. But cocoa can also be grown in Central America and I believe South America, which my guess, it doesn't matter the fundamental part. I'm not an expert there, I will say that, but I'm sure they'll shift a lot of production. They'll start growing it with these crazy, insane. I mean, this is cocoa right here, and cocoa's not going to go away because it's needed among other things, obviously chocolate. But this is where cocoa had been for years. This is 2014, 2015 back here. You can see my year breaks. Sorry, let me grab the right tool here. 2015, 16, 17. This is where cocoa normally trades, and it's gone parabolic. This is log scaling. So don't think that move is not as big as it is. It is like 13,000. Back here was 3,000. So that's a huge run. Parabolic advances don't end well. We actually shorted off that one too for that reason. Parabolic advance. Covered that. And anyways, ultimately, this one I think has a lot of downside as well. The symbol, if you're a futures trader, well, you probably already know this, is CC. This is my 120-minute chart. Let me just drop it down so you can see a little better on a 60-minute chart. I've got an alert right there. You can see I have an alert set here. So you're in this trading range right now, this band right here. There's a midpoint line right there, roughly a little bit above the midpoint, but that's support. And that's right at about 11,009. Once that support level breaks, that will, in my opinion, bring us to the bottom of the channel, provide an objective short entry on the breakdown there. And then when that goes, that will be a more powerful longer-term sell signal. Upside break could bring us out to new highs, or at least over that previous high there. So you could keep a stop somewhere in there or above that level there. And again, longer term, there's a lot of downside potential in this one. Update on nat gas. Nat gas still sucking wind after that divergent high on the 60-minute chart. Still not at my long-term target, which is just shy of $5. But what we do have, and it's not a buy signal, it's a condition, positive divergence. Remember, it was this negative divergence, sent us down for this correction. We're coming up on support here. Nice support, about 3,127 plus the uptrend line, dual support levels. Provide an objective entry here down to really not below this level. Anything below there is going to get ugly, I think. But as of now, when I look at the longer term charts, I'll go to nat gas here. Let's find it. Natural gas, natural gas, natural gas. Here we go, weekly. And this is the chart I've been sharing for a while now that has my longer term targets and the entry points. We're buying it down here. Long-term, really great long-term support, big positive divergence. I mentioned that the average rallies run about 200%. We've already gotten that. So I do need to say that we've hit about the average in the recent highs, 200%. Right now, natural gas is trading at about 360 right here. So this is support. We're right now pulled back to this support level. As ugly as today is, 10%, that's just run of the mill. A 10% move is normal. Natural gas is super volatile. It was up 25% a few weeks back in a single day. So as long as it holds this level here, I think we'll get that one last thrust up to that $5 target there. There's a uptrend line. It could even may want to come back to. If you look at the past rallies, 207% right there off that divergent low. Nothing goes up forever. You get corrections along the way. But what I don't see right now, this rally here ended with a divergent high. That ended with a divergent high. This one ended with a divergent high. That one ended with a divergent high. We don't have anything close to negative divergence. So that's what I'm still leaning towards. One more last thrust up to that area. You just have to ride out if you're swinging at the pullbacks. And the key to trading natural gas successfully is don't put too much in it. Beta adjust your position size down, commensurate with the volatility and the gain loss potential, meaning take a much smaller position than you would on other things there. And last but not least, crude oil. Remember, we had this divergent high recently here that was a catalyst for this drop here, correction. Trend line was broken. We have positive divergence, but once again, divergence is not a buy signal. It's merely a condition. Maybe a little bit of support right about here, about where we are, but this is better support. If you get around $72, and that positive divergence is still in place, it might be worth a shot, taking a shot long crude CL at 72 with a stop somewhat below, somewhat relative to your price targets, and or means a starter there, for example, and on a break of the downtrend line right there. You can see my downtrend line right there on crude. So there's crude, currently in a downtrend, but with positive divergence. Okay, long video, but I've kind of packed a lot in. This has been Randy Finney with Right Side of the Chart. Have a great day, and remember, you can always hit the fast forward playback speed on these videos, increase it to 1.5, 1.75, whatever, and get through them a lot quicker, especially during the day.